Hello everyone, it's Ultimate. It's a Saturday. I was just walking on my treadmill, attempting to try to get back in shape from what happened with the pandemic. So I'm going to have two videos for you. They're both going to be short, maybe 3 or 5 minutes long each one. But I got a lot of questions about both topics earlier on today and also the past couple of weeks. So the first topic I'm going to go over is why not to play with momentum are speculative stocks or stocks that don't make money if there's a correction. Now, the good thing is the last 2 weeks, about the last 2 weeks, like the market has come back where we're not in correction mode, meaning down 10%, because we were down 12%, we're down 8, now we're down 3, so the coast might be clear, but we're coming into an earnings week. So I'm going to use two examples. Now remember, I like these stocks. And I'm going to use two examples of growth stocks and two examples of super defensive dividend stocks. Why when things are looking bad not to. Now one, which is super famous now, and I believe in the company, is TDOC, symbol TDOC. Another stock I actually put on my plate before is AFRM. AFRM. So these two companies are super growth companies. They both actually don't make money, but the field of business that they can go to, expand to, is tremendous. So that's why a lot of analysts, a lot of TV heads, a lot of money managers like TDOC and AFRM because the growth potential. The field of opportunity is limitless. One lets you do a doctor's appointments on your phone. Another allows people like myself or regular people to borrow money and pay back slowly. Now, both companies don't make money. Both companies don't earn anything, and they both grow. So what happens is when the market gets defensive, like TDOC dropped like 30% off its peak. Firm has dropped over 50% off its peak. Why? Because when everything works and everyone is making money, people just bid. They're happy. Everyone looks the other way. They see a firm or TDOC closing at like $200. I'm just using an example. So TDOC closed at $200. Our firm closed at $100. So the next day they just look at the last closing prices as a reference point. So they believe, hey, the market sentiment in the morning is good. The futures are up. I'm going to bid 202. On our firm, I'm going to bid 102. So people are bidding stocks higher because when everyone is making money, nothing matters. Everyone's happy. Everyone's making money. They don't care whether or not the company is making money because you're making money on the stocks, not the company. You're making money in the stocks. So what that means is the way you and I are making money is by taking a tracking of a company, the stock, and selling it to someone else that believes it's worth more than what you're selling it for. But when there's a correction, that doesn't happen because what happens is the speculators, the people betting and hoping for a future, get scared and get out, and all the people that buy for value and no go to high defensive dividend stocks. So like I said before in posts, Ultimatetraders and Reddit, when things are going bad, stay away from high-tech stocks. Because as we noted earlier in another video and a lot of posts, when a company doesn't make money, they don't have cash on their balance sheet. And they need money. They come to the market to sell more shares. Or they come to the market with convertible bonds or bonds. That means they're going to drop the price of the stock. They need money. So you stay away from those stocks because there's no bottom. There's no bottom because let's say that we're talking about TDOC right here and TDOC drops to 100. Why can't it drop to 50? There's not enough cash on their balance sheet to buy back shares. Someone bigger is going to have to come in and buy. Now, someone bigger might not come in and buy because they're going to see it lower. Now, if you're talking about TDOC or firm, 3 to 5 years from now, why are you looking at the stock on a daily basis? I understand if you want to take a look at the stock like every week or once a month, but do yourself a favor. If you're looking at 3 or 5 years out, do not look at intraday activity of a stock. I don't even recommend you looking at daily activity of a stock. Maybe week to week, month to month, because what you're going to do is drive yourself insane. Now, at the same time that TDOC was down 30, 40%, or a firm was down close to 50%, take a look at PSEC making new 52-week highs. They pay a dividend. So those investors of high growth are the people that know what's going on, jumped out of a firm, jumped out of TDOC, and went to the super defensive high dividend stocks. ARCC is another one. Aris Capital. So these two companies that pay good dividends are at all time, well, not all time, but 52-week highs, while the high techs got lowered. Now, can the high techs come back? Yes. If we make another bull run and we're in the green and we're making new highs, they will come back. Because what happens is people bid. They're going to be happy. Everyone's in the green and it's going to go up. But that's why when things get bad, be careful. It doesn't make sense to do high growth stocks with no P's, low P's, or if they don't make money. Now, once again, I do like TDOC and I do like AFRM, but these two companies only work in a bull market. All right. Have a great Saturday. Bye-bye.